Hello, everyone, and welcome to today's Energy Storage News webinar with Grid Beyond, where we'll be looking at the monetization of battery storage assets and how to balance risk with reward. I'm Andy Colthorpe, editor of Energy Storage News, and I'm really excited to be here alongside three experts with deep knowledge of the UK energy sector and the role batteries play within that. There are around 4 gigawatts and 5 gigawatt hours of operational large-scale battery energy storage system, or BESS, assets on the GB grid today, according to figures from the UK Battery Storage Database report produced by my colleagues at Solar Media Market Research. Now that represents a staggering growth since 2016, when the first 200 megawatts of contracts for the Enhanced Frequency Response Ancillary Service were tendered for and led to the first projects at megawatt scale going online a year or two later. And Solar Media Market Research's database also tells us that the near-term pipeline of assets in development represents 60 gigawatts of batteries that could connect to the grid with 92 gigawatt hours of storage capacity. So it's very exciting news for the industry and ultimately for the UK's energy transition goals. On some days during 2023, renewables, with wind as the driving force, represented more than 50% of demand on the grid at times. Now that is truly fantastic. But it also means volatility is growing, and battery storage is an amazing tool to smoothen that out if it is deployed in the right places and put into service in the appropriate grid balancing opportunities. And so this unprecedented growth of both renewable and storage means that the industry also has to mature at an incredible rate. Taking the energy stored in batteries and making the most valuable use of it is kind of a fine art backed with very precise science and leading edge technology, operated and administered by human experts in trading as well as in engineering. While the artificial intelligence can be trained to see the patterns and call the trades, it can only do so in alignment with the strategies the human operators implement. Our three speakers today are very well placed to offer perspectives on both the bigger picture issues driving changes in the market today, as well as the day-to-day specifics and nitty-gritty of trading and optimizing BESS assets. So leading the discussion will be Scott Berry, Asset Development Director at Grid Beyond, a technology platform provider for trading flexible and distributed energy assets. Hi there, Scott. How are you doing today? Oh, just lost Scott. I think he's probably great timing. I'm sure he'll refresh and join us. But Scott will give us a bit of an introduction to Grid Beyond and himself as in due course. And also with us is Charles Pearce, Head of Commercial Products at Zenobē Energy, which I'm sure many of you already know of well as a leading investor and developer in BESS and electric transport infrastructure solutions, as well as a winner of 2 prizes at the Energy Storage Awards 2023. Hi Scott, glad you could get back to us. Scott, we'll let you introduce. No problem. Oh, here he goes again. Charles, as I say, Zenobē probably doesn't require that much introduction for many of the people watching this, but just to your particular role and what you do, just a few seconds on that, please.
Yeah, sure. So thanks for having me here today. I'm head of commercial products, and one of my key roles and responsibilities at Zenobē is the management of our route to market contracts for our development assets. Zenobē's probably been a leading innovator in the use of long-term floors for financing our development battery assets, of which we have over 230 megawatts operational now. We've got 500 megawatts in construction and a solid secure pipeline of over a gigawatt. And I think we're expecting that some form of floor tolls will make up the backbone of how we bring those sites through to operation.
That's fantastic. Thanks, Charles. And also with us is Henry Easterbrook, Chief Executive of Fig Power. Fig Power is a developer founded by and spun out from construction engineering design consultancy Hydrock. Henry, I guess, is a slightly newer company, Fig Power. Maybe, a little bit of introduction there and also your particular role, I guess, and your interest within the sector.
Yeah, sure. Thanks, Andy. So yes, Fig Power, we're a developer of storage assets. We're having spun out of a large engineering business who were naturally more akin to the sort of slightly more complex and innovative projects. We've got a portfolio of GB-based storage projects, and recent transactions include a 4-hour capacity market-backed contract that's sold at shovel ready. And my role in this is to lead the business as a whole, but also I bring a background as a quantity surveyor, which is slightly alternative, with 20 years experience of managing engineering projects from a commercial perspective. So batteries are an area of intense interest for me.
Terrific. Well, thank you so much for joining us, Henry. So, as I mentioned earlier, Scott will be leading the discussion today, but I'll be asking a question or two of the panelists as we go along to keep them on their toes. But as always, interaction with you, the audience, is really important to us. So please do put your questions for the speakers in the questions tab you can see on the right-hand side of your screen. We will have a few short few minutes for a Q&A at the end. And now we can't promise to answer all of your questions in the short time we have, but we will try and cover as many as possible. And Grid Beyond and our other speakers will be happy to follow up offline and to continue discussion. And finally, today's session will be recorded and available to view on demand on the Energy Storage News website a few days from now. And so without further ado, I'd like to hand over to our first speaker. Hi, Scott.
Thanks, Andy. No matter how much you practice, you always get disconnected as soon as you go to speak for the first time. So so a quick introduction to me and Grid Beyond as our first port of call. So I'm Scott Berry, I'm the Asset Development Director for Europe and APAC. So I'm primarily focused on front of the meter optimization and growing that portfolio, and also providing our software as a service for our designer products, our forecasting products, and our bid optimizer and auto bidder. So a little bit about Grid Beyond. So Grid Beyond was formed in 2007 in Dublin, and we have now developed into a global company with offices in the US, in Canada, still in Dublin, the UK, Australia, and Japan. We started off as a behind-the-meter demand-side response company, where a lot of our capacity lies in terms of assets under management. We currently have over 2 gigawatts of assets under management, and we have about 450 megawatts of batteries under contract. We have approximately 120 employees across those territories. We have 500 customers and partners. We've been managing batteries behind the meter for between 6 and 7 years now, which doesn't sound like a long time, but in the battery game, that's a pretty long time. So we've become experts in monitoring and managing state of health as well as optimizing revenue. And we're now bringing those expertise to the front of the meter assets. So on to the matter at hand for this webinar. So do higher risks mean higher returns for battery storage? So as the UK market is continuing to develop, investors are changing, the structures that they look for in the market. Some are becoming more comfortable and some are still looking for more certainty. So the current structures we tend to see in the market are fully merchant structures that look like a revenue share model. Floors where optimizers are giving a minimum level of revenue to the asset owner, and tolls where essentially the optimizers are paying a fixed cost to the owner and they take complete control and complete revenue risk with the asset. So I suppose thrown out to my fellow panelists. So Charlie, what are you seeing out there in the market? You've developed assets. Do you think floors are worth their price at the minute? I mean, you're usually paying between 8 and 10% for a floor. Is it worth it?
Yes, I think it is, in short. I guess it depends what your risk profile is, right? So we're essentially an infrastructure fund, and like the risk profiles associated with that. And floors give us access to both like the secured revenues we need, but also the merchant upside in terms of higher periods, which really gives us that sort of IRR kick and makes these projects really, really profitable. I think the cost of floors in the UK is generally quite low. Like these floor levels tend to be quite out of the money and robust to quite low level market revenues. So usually we consider the risk of these floors being tested as quite, you'd have to see quite a prolonged extreme market conditions for that to be the case. So yeah, as you say, generally floors between 10 and 12%, let's say, and an optimizer maybe 3 to 6% for just pure optimization, no hedging. I think we generally find that provides a really, really attractive offer for us.
Okay.
And I guess we continue to see quite strong floor offers from the market as well. So I think that provides really strong signals that providers are willing to sort of back the long-term battery market with their capital, their risk capital behind that.
Absolutely. And Henry, what are you seeing from your side?
Yeah, I mean, I don't want to contradict anything Charles has said, because clearly there's a successful model being used there, and us as developers, we're bringing forward assets that have, on an agnostic basis, that could be used either for in either sort of measure. But I think there's a few kind of fundamental questions in my mind around batteries. By their very nature is revenue risk, and if you're going on a journey of investment in batteries, then it seems perhaps counterintuitive to buy at the main risk reward parameter. I could well see that, where debt is a major feature, or for certain investors like IHT funds, where risk is a primary driver and cost of capital is low, it could potentially open up the market to a wider audience. But I guess I question whether there's enough certainty on those main parameters that inform the revenue that's achieved, both revenue, OPEX, regulatory risk for a floor or a toll to be good value. You're trying to de-risk something when the fundamental feature of that asset is that risk, so it may prove to be poor value. But yeah, certainly with interest rates higher, equity playing a larger part in the financing of these projects, it may be a less sort of widespread feature in these projects, perhaps.
Absolutely. And we've just had a question to explain a little bit what tolls are, and we're going to come on to my second anyway. So essentially, and Charlie, Henry, feel free to jump in here. A toll would be when an optimizer, for example, Grid Beyond, would pay Zenobē, for example, Charlie, a set pounds per megawatt each year to basically rent the asset from them. And then what we would do is we would optimize it, but we would keep all the revenue. So essentially, if you think that you can beat the toll price, you're going to make money. But if your revenue optimization of the market falls off and it's below the toll price you're paying to the asset owner, then you'd be losing money in that scenario. But the asset owner has a fixed return. I think that was a fair description, Charlie.
Yeah, it's pretty good.
Yeah, good.
So I guess, like from our perspective, we're not adverse to tolls, but at the moment we haven't really been seeing levels that make it support the sort of investments that we're looking to make. So tolls have been a lot more prevalent in our US discussions, and I think they're continually used over there. But the main limiting factor for us has been sort of the tenor of these contracts. They've been more focused around 3 to 5 year tolls, and that really doesn't support our business structure in terms of getting large amounts of secured revenues into the projects. We're increasingly starting to see more tolls being offered in the UK, and I think that's a really promising sort of new area of structuring that we're definitely going to look to explore further. But again, for us it's more about getting the right tenor, and also sort of obviously the level of these tolls to make sure we can get the investments and pass our hurdle rates for these new projects.
Yeah, because I would have said before a few weeks ago, I've never seen an attractive toll in the UK market, whereas now you're starting to see some figures come out that might actually hit hurdle rates and IRRs for some of the developers. Henry, what you see on your assets, you must go out to market and have an idea of what people are offering.
Yeah, we get to see something that would result in a viable project. I mean, I'll sort of caveat that by saying there are certain types of investors, very low cost of capital, where the certainty could open up the asset class to a wider sort of capital market that wouldn't otherwise be comfortable. Those that are coming out of contracted revenue on renewables, batteries is a big step, but if a toll could cover most of the risk, then I think we'd see a much larger sort of range of participants in this market, which can only be a good thing. I just haven't seen a toll that would result in a viable project, personally.
Excellent. Anything from you, Andy?
Yeah, sure. Just before we move on, folks, and I think people are going to have to get used to the three of you having a very detailed and top level discussion, and me swooping in with some probably quite basic and general questions, but maybe they'll help open up the discussion or perhaps give you a little bit of a different perspective to think about. So I think one thing from me as someone who's, clearly outside of all the trading and business activity that happens, but is an observer to a lot of it, I hope. What's the best way to develop an understanding of realistic revenue expectations for battery storage? So, I mean, we hear a lot of stories that, I think battery storage is a lot about capturing the volatility in energy systems. And to skip over to another market where, both Zenobia and Grid Beyond, I know, have an interest in is the US. And, we saw with extreme weather conditions in ERCOT, which is in Texas, a couple of years ago, some battery storage assets were making, I think, what would have been the sorts of revenues they would have modeled over a period of months or even years, being earned in like days, which is obviously sounds fantastic and a bit of a gold rush, but presumably that's not really how we run an energy system over the very long term to be sustainable. And it's presumably not necessarily that useful for investor expectations to not really know, kind of what to expect, I guess you could say. So kind of what are the fundamentals that we need to think about in terms of that? And Charles, I think as you did refer to sort of some assets that you have and the way you monetize those in the US, do you want to just maybe start off there and see if the other two want to jump in maybe?
Yeah, I think fundamentally I see the revenue profiles over time has been slightly different from your classic baseload asset. So Texas is probably the extreme example, but I think it provides a bit of an analog for like the longer term returns of a battery asset. And clearly when we're forecasting these, we forecast these in a nice, smooth sort of long term trend. But in reality, we'll see more volatility on these prices over the long term, which will average out to that to justify the business investment, hopefully. But yeah, for Texas, you get a year's worth of revenue in 2 weeks. I think the UK at the moment, we're probably seeing one of this like sort of a low period of returns, but we expect, we'll see the spikes throughout the course of an investment that sort of really justifies that business case.
Yeah, I think that's absolutely right. And, in ERCOT, in Texas, there where you're talking about, you make so much money over such a short period of time, availability becomes very, very key in that market, that your asset is available to make that money. Otherwise, you're going to have a very bad year. The good thing about the UK market is because it's mature and, there's actually opportunity throughout the entirety of the year. And, I think as we continue to see, thermal plant go offline, more volatility, as Charlie said, in terms of wind generation. You see baseload overnight and peak spreads. You're going to have some years where in winter those aren't great, possibly like Q4 that we just had, and you're going to have some years where they're much better. For example, when you have gas supply shocks like the Russian invasion of Ukraine, or interconnectors go down or go on fire, there's going to be years in these cycles, in these investment cycles, that are really good, and some that are below average, but on average they should come into investment grade.
Sure. And Henry, I don't know if it differs because we're talking about, you mentioned very complex assets. So I don't know if it differs from different types of assets, but yeah, what's your perspective on that?
Yeah, I suppose in sort of lay person's terms, we've seen an evolution of we've sent blocks of power into grid and rewarded for stabilizing frequency, and now the sort of buy low, sell high opportunity is starting to become more real. But where you see exceptional pricing events like in ERCOT, that's a clear price signal that will stimulate investment, and there'll be market participants that respond to that. And it's not completely dissimilar to what we saw in GB with dynamic containment, and that then later saturating, and an emerging opportunity around arbitrage. But I do feel quite strongly that we can't analyze past performance to make a prediction of the future, because it's skewed significantly by particularly gas, with a low marginal cost of generation in terms of fuel and carbon, which won't be the same going forward. And just the availability of an aging gas fleet and the sort of commercial challenge of building anything new, which is going to preclude anything really coming on, there's going to be a completely different dynamic for the future, and batteries will provide some of those services that historically have been, the sort of narrowing spreads that have been closed by gas will be, create an opportunity for batteries that we haven't seen yet.
Yeah, I mean, absolutely. I think that's what we kind of need to see, really, isn't it?
Yeah, absolutely. And I suppose that kind of leads on nicely, Andy, to our next point of conversation, which is what is the outlook on BESS revenues? So, obviously 2023 on paper didn't look like a great year for BESS assets. We're now seeing frequency markets saturated. We're seeing National Grid bring in the enduring auction capability, which reduced prices even further. So we've seen that impact revenues and possibly more reliance on market arbitrage opportunities and using more cycles in those. But in terms of the future ahead, so we've already touched on some of this. I think looking at the fundamentals of between 5 and 10 years in the UK market, as more thermal goes off, as you've got a higher penetration of renewables, there should be more arbitrage opportunities within day. So I think that's really going to push an increase in arbitrage revenues, but also reduced thermal means there should be increased requirement for frequency services. I think there's going to be more enough batteries to saturate those markets still, but they should act as support to each other, as the opportunity cost of one should set the price for the other. But what do you think, Charlie? What's your outlook on kind of 5 to 10 years in GB fundamentals?
I think we're convinced that there remains a solid business case for batteries. I mean, they're a key piece of that puzzle to helping us transition to net zero. I think there are some headwinds at the moment, so like slightly slower res build out than we're expecting. Chat of new programs, and say like grid maybe not achieving the dispatch rates that we believe we should be achieving. But I think all of those, I'm convinced the renewables will pick up the pace, and then we'll start to see that wholesale value really materialize in the market. And yeah, I think we're more than confident that the opportunity for batteries is there. Providing that we will, you've got to make sure that we're driving down OPEX and CAPEX, right, and making reliable projects. I think that's the other side of the argument for us as well that we focus on.
And
Henry, what do you think? What's your outlook at?
Yeah, I just think we're going to see a much more sophisticated view. Things like location are going to be a much bigger factor in asset performance. We have a fairly sort of clumsy system at the moment where assets can be the wrong side of a thermal constraint on transmission network and enjoy the same kind of revenues, even though they're not adjacent to load centres. So I think whether it's the BM or constraint management or just avoiding use of system charges, I think the location of assets ought to be a much greater factor in how they perform. And of course, that's a key consideration at the site selection stage. And the slightly more complicated view that I've got, which I couldn't articulate entirely, is that we'll just see more elaborate ways of trading these assets. Batteries are effectively an option, having sort of extrinsic value around how that's traded in the future. Long dated optionality, base load, peak load spreads out into the future are the kind of things that might happen that drive additional value, a feature in a revenue stack for batteries that aren't there currently. So we'll see something more akin to sort of financial derivatives in the way batteries are traded potentially.
Yeah, I think you're right, Henry. I think access to long-term markets and those types of sophisticated financial derivatives will be a game changer for batteries, because it allows you to not only lock in value, but you can lock in, unlock value, and then lock back in based on the volatility of the market if you delta hedge it. And yeah, you mentioned there about balancing mechanism dispatch rates, so skip rates from National Grid. So they haven't been great over the past year or two, but I think National Grid are making a real push to try and improve them by improving technology, and it's used in the ESO control room. But I think that all of that will come to improve business cases. I see 2023 is quite an isolated year, probably just one of those years that you bounce off the support on the curve, and we should move back towards the average. Is that your view, Charlie?
Yeah, very much so. We see pretty much historic, low gas prices. As I said, all the other sort of short-term headwinds that we're experiencing at the moment. And I think, touching on Henry's point, the continual evolution of the products and services that we can bid into increases this optionality value of the batteries and allows sort of us to access more value pools in the wholesale market.
Henry?
Yeah, I mean, definitely the outlook is good. It's just with my developer hat on, it's very difficult to provide certainty of this at pre-construction stage. We can see there's lots of ways that this could go, and people are interested to see a DCF that demonstrates a return that is acceptable. But there's a lot of assumptions in all of this that are quite difficult to get people comfortable with at times. So yeah, we need a kind of evolution in people's thinking and probably some more extreme events that provide these price signals that get people comfortable. I mean, there's a sort of more simple point around combining battery assets with, let's say, subsidy-backed wind assets where there's a kind of counter-cyclical hedge between them. Assets that like volatility, like batteries, put them alongside those that don't, and then the performance of the two is sort of diversified through them. And I think that's a really simple way of looking at this, and just in the nature of who owns these assets. But I'm sure we'll see more of that going forward.
Absolutely. And I think what's key there, when we start talking about how PPAs interact with them and how, co-location might impact it, and different financial derivatives and different options of how to actually dispatch these assets in more markets. I think somebody, asked in the chat earlier on, is auto bidder, or kind of the ability to, use AI to, bid into the market, a game changer? And I think it is, because calculating the trade-off between these things is becoming a mammoth task that you can't, and I used to be a short-term trader. I wouldn't like to do it now on battery assets. So yeah, I think it's going to be AI is going to be such a strong tool going forward, like we've developed at Grid Beyond, to actually help manage these assets. And especially in markets like ERCOT or in Australia, we have 5-minute settlement periods and stuff like that. I mean, that just sounds like a nightmare to me, to be honest. So I'm glad I'm avoiding those. My training days are behind me.
I like so in terms of that AI, I think that's clearly driving a sort of a revolution in the trading, right? But I also think there's still a lot of value in the oversight from the traders and the structurers. For example, you could take ABSVD versus non-ABSVD. Like auto bidder can't sort of re-register your VLP, for example, and shift in those markets. So you've got the sort of the trading tools, but you've also got the sort of the people and managing the structuring of how those assets are framed in those markets and allowed to access those markets.
Absolutely.
Okay, so yeah. So we're hearing a lot about what I believe to be really responsible approaches and trading strategies from you folks. But I want to play a little bit of devil's advocate here. And Scott, I don't know if we can cast your mind back to the dog-eat-dog world of short-term trading, let's say, and put yourself into that high-risk mindset. So yeah, the premise of today's webinar is indeed, do higher risks mean higher returns? And I think the sensible answer is obviously that managed risks make good returns, I suppose, would be, a financially illiterate way of saying it, but probably makes sense, I guess, I hope. What I want to ask is, what are some of the higher risk strategies for best market participation, and what's really at stake? So let's just say, for argument's sake, that someone with a lot of money just throws it at you and says, here's the keys to my best asset. I want you to just go for it in just the most high risk strategy you can go for. What does that kind of really mean? And like, what other things kind of come into play when we talk about risk? So one thing we hear a lot about is managing the battery's health in itself, and not degrading the battery by essentially just working it too hard. Other things might be, like you mentioned before, Scott, not playing too far into one market so that you've got availability for the other opportunities. Yeah, what do we really mean when we talk about risk, when we talk about battery storage? And I don't know if you want to start that one off, Scott, and if Henry and Charles have got a view, then we'd love to hear this. Sure.
So yeah, there's more than one way to trade the assets like this. And also in different types of markets, you might look at it differently. So the difference between a pace cleared market or a pace bid market, for example. So I think in terms of how you want a high risk strategy, if you're very high risk, you might want to disregard your warranty, or you might want to push as many cycles as possible into the early years of the battery, so that you may be degrading your battery faster, but you're bringing that revenue closer, so it gets discounted less in an NPV type model, for example. Also, for example, if you're in the balancing mechanism, what you're offering volume to the market at, that price can be dictated by your risk level. So if you're going into a winter peak, there's a big difference between being offered in at £400 a megawatt hour and £4,000 a megawatt hour, and that's a very, very big risk difference, because the £4,000, there's a very good chance you're not going to get called, but if you do get called, it's going to make significant revenue for you. And when you start pushing prices in that kind of direction, then you also need to become very aware of your regulatory concerns. So things like TCLC, and making sure that you're not exacerbating constraints on the network to make excess revenue. So it brings a new set of risks. But in terms of just where you price yourself in the market, you can dictate your risk strategy.
To be clear, though, I guess for example, on the warranty point, your optimizer, I guess, would probably strongly refrain or advise or even consider those warranty terms sacrosanct, I guess. So there is a limiter, yes, I suppose, to that level of risk, I suppose.
Yeah, unless the owner doesn't want, is looking to possibly take an insurance product that would actually replace the warranty, or that would allow them to push the asset harder, or they want to take the risk. I mean, that would be high risk, disregarding your warranty.
Sure. And Henry, for you, what does risk represent in the BESS market?
Yeah, there's a few things, touching on the point there. I think there's a lot of batteries that were designed for power trading that are now going to be increasingly under pressure to do energy. So rather than short-term blocks, we're seeing longer, deep cycle sort of trading of energy. Now, those batteries weren't necessarily designed for that, and you're going to be sailing extremely close to the wind on warranty and performance guarantees if you're going to use them in that way. And that's kind of obvious. Everyone will know that. But perhaps the risky view, if there is any merit in this, is that you could look at the sort of sharp decline in OEM costs and cell costs, and the predictions for them to be less than half what they were last year, and adopt a more aggressive trading strategy and bring forward the repowering of these assets based on likely sort of lower costs in the future. I mean, to me, that seems like an appropriate sort of view to take, given the opportunity you'd otherwise miss. But that's clearly the kind of thing that's going to be on people's minds going forward. There's a second point, and this is even more risky, but currently you wouldn't be motivated to build, say, small distribution assets in heavily sort of congested and constrained locations. But there's a reasonable argument that says those assets could be put to work very effectively in the future as a way of avoiding those physical upgrades that are required in those locations. And if we see constraint management services come through, and if there's longevity in them, those assets could perform very well. Again, no observable price signals at this stage, but if you were having a punt, then that would be one area that would be worth considering.
Because it comes back to that favoured term of journalists and analysts everywhere of fundamental drivers, I suppose, underlying that. And Charles, finally, Zenobi, I guess infrastructure and risks, kind of two words that have generally kept us as far apart as possible. But from your point of view, how do you kind of view risk in terms of BESS trading?
Yeah, I quite like Henry's point about taking a punt on locational value, like, taking it a step further, maybe LMP, for example, if that did come in, for example, could be even more upside if you were particularly strategic and got the layout of that right.
So locational, sorry, just for the benefit.
Locational
marginal price, right. Yeah.
Yes. I think, again, for us, our warranties are generally pretty sacrosanct, both from our investors and also from our lenders. But I think if you were running a fully merchant asset and it was your money, like, I think the optionality that you'd be free to play with around how much you thrash your asset during periods of high revenues opportunities, I think it's a really interesting question, and it's not something we've really given a lot of thought to yet, because we're just not in that space. But I think it's an interesting opportunity, and I think generally for our perspective, we're about stacking contracted revenues. That's our goal, and I think we see new markets like forward trading being really interesting. And again, there's a risk decision there about do you try and lock in sort of known returns forward, or leave your exposure open to sort of day ahead and more volatility potential, and also the new stability and reactive power services from Grid. We've got a range of day-1 to long-term contracts. Understanding your risk reward between those different horizons again is another sort of area of interest.
That's great. Thanks, Charlie. So we'll move on in the interest of time. Thanks, Andy, as well. So in terms of this whole risk reward question that we're looking at, so what's changing in the industry that can actually give investors more confidence? We're seeing pretty strong capacity market results. We're seeing National Grid promise to automate and processes in the control room to try and improve BM dispatch of batteries. I think co-location, people have asked questions about it in the chat. Co-location is a very strong trend that I think offers, pretty attractive returns, because it can allow you to oversize the renewables to your connection, etc., and use the battery in that way. So, as developers and investors, working for them yourself, what are you seeing that's in the market that's innovative, that would give investors comfort, to take possibly more of the volatility on, or where it's not all laden on the market risk? And Henry, do you want to come in on that?
Yeah, sure. I mean, it's kind of broad, isn't it? But I guess, there's coming out from a few different angles here. There's some insurance products that are coming through now that can deal with some of the risk around outage and problems with supply, which for certain investors will be really attractive. It's quite a complicated thing to price. So I think that would naturally bring forward the awareness of how much risk exists in particular sites, and rather than buying out that risk, it would just promote site selection to avoid the risk of outage, increasingly so. Otherwise, it's cost prohibitive to insure against it. I think there's a sort of less tangible point, which is we just got more historic performance to analyze, and I think people will get more comfortable as that happens. In the sort of 3 or 4 years that I've been really heavily involved with this, each year has had a fundamental challenge. Initially revenue stack, and then supply chain, and now last year it was grid, and it continues to be grid. But then we do seem to overcome these challenges and become more comfortable with things that were really difficult, and that will be the case for several obvious opportunities like co-location, which is stuck around sort of commercial and regulatory points at the moment, and that will just allow greater access to capital markets, and projects will get built and be operated, which is what we want to see. To pick any one point might be difficult.
Yeah, and it's interesting you talk about insurance there, Henry, because you do get that parametric insurance that looks at availability and health of the asset and stuff like that. But we are also seeing offers come into the market of insuring your revenues, and saying essentially you can get a price from an insurer rather than from your optimizer, which would be an interesting opportunity to take a very large investment grade insurer's credit line for a floor, and it means you could work with some of the smaller, more innovative optimizers. What do you think, Charlie?
Yeah, I think exactly. We're really interested in that sort of new space, both because it brings a massive new pool of credit, right? So the reinsurance firms have got unlimited capital to deploy, right, in diversified projects, compared to maybe the incumbent sort of supplier floor providers in the past, but not in the past, that we're still using and key to the market. I think the interesting bit about disaggregating the hedge from the route to market provider is it just removes the inertia from being linked to a single optimizer. So from a developer's perspective, I guess that opens up the floor to more optimizers to enter the market, because they don't need to secure the financial backing for the floors, and also just increases competition, and it sort of adjusts how much onerous we need to put on benchmarking. Benchmarking is a massive element of our floor contracts. But if we haven't got such a developed benchmarking to worry about, because we know we can just switch optimizers, that if their performance is continuously poor, that provides us a lot of confidence that we can always be securing the higher end of the market's returns. Well, that would be our objective.
Excellent, thanks for that, Charlie. And then Andy, I'll hand over to you. That's the end of our organised segment, and then we can move on to questions if you've got anything, Andy.
Fantastic. Yeah, thank you very much, Scott. So so in the interest of time, I think we're just going to have time to do a couple of these audience questions, but let's take them on. And as we mentioned, we did get a lot of excellent questions in from the audience, and we won't be able to do all of them by any means. So Grid Beyond will be able to get in touch with you and continue that conversation. But so one question that came in from audience member Balaji. Hi Balaji, I hope I got your name right. Says Balaji's worry is that standalone UK battery storage is reaching a level of capacity growth that does not have enough capital to absorb very long-term merchant risk. How do you see this playing? I guess firstly, is that sort of a premise that sounds familiar to you guys? And how do you see that playing out? If so, or if not, why not?
I'm not sure about that one. I think there's actually quite a lot of capital available if you know where to find it. I think it comes down to your source of capital. So, for example, Zenobē, for example, so Charlie see themselves as an infrastructure fund. So infrastructure likes to see, regulated return almost. So they like to see, a nice highly contracted value. Whereas if you're looking at, PE or other types of equity backed capital, they're probably more willing to take the risk and they want to cash in on that short-term volatility, which is what batteries are designed to monetize. And also, I think, there's a huge pipeline of projects. Not all of them are going to get built. Probably half the pipeline, I imagine, could probably go. So I think there should be enough capital to cover it.
Yeah, certainly. I think the 60 gigawatt pipeline that I mentioned at the beginning, that's very much not a pipeline of dreams as such, but it's a development pipeline, and it's not a construction pipeline by any means. Anyone else have any other views on that, Charlie, maybe? Or just if there are any other views generally on, I think one thing we heard from early markets like Germany or PJM in America is saturation came quite quickly. My understanding is that's based around them being quite limited, let's say, frequency regulation opportunities. But I don't know if there's a wider point on that, Charlie, or if you want to just reply to the original question that Balaji asked, I guess.
Yeah, I don't see a shortage in capital. I think you see a lot of large-scale investments in battery firms at the moment, or funds, and also increasingly lenders, so like the sort of cohort of banks are keen to continue lending money to battery projects. They're gaining in confidence, and more banks are trying to get in on the action. So yeah, I think for people with a good track record and delivering quality projects, I think we're not seeing a shortage of capital.
Yeah, just jump in as well, because this has been something that's plagued us a little bit in the last year, is this mass development pipeline and concerns around saturation risk, which I can understand why that's valid. The quality of that pipeline is extremely mixed, and I think what we've seen is an advent of pretty low barriers to entry for development. Lots and lots of very speculative projects from people that didn't understand the fundamentals of this and the real basic principles of site selection. So we're expecting and looking forward to seeing lots of sort of attrition and consolidation across the market, and development has become much more capital intensive, so it will naturally filter out those who were perhaps more opportunistic, and the consolidation will see development activity being done by well-heeled infrastructure funds, utilities, commodities trading type businesses, and that's a more sustainable model in our view.
Excellent. And there's a question here about a topic that you guys did come back to a couple of times throughout, but I think it's very elegantly asked by our audience member, and I think it's good to maybe just what's the word? Dot the I's and cross the T's, not the other way around. So Andres, thank you for your question, asks, what is the view of the panel regarding dynamic PPA, so power purchase agreements for battery storage, particularly with the increased volume of hybrid projects, etc. So this would be hybrid, presumably with renewables, not specified, but presumably with renewables, hybridized. Will there be a strong market for this to deviate from only NG, presumably national grid service markets? And Henry, since you did bring it up, I recall, do you want to just maybe start off with your thoughts on that and see if anyone else wants to chime in?
Yeah, I think I understand where Andreas is going with this. I think there's a potential huge opportunity, huge market to be met around demonstrating that from a corporate off-taker, and this has been led sort of commercially rather than regulatory, they can demonstrate timestamp regos for the power that they're buying. And to date we've seen a lot of corporate PPA activity that's with a sort of annual settlement period. As that becomes more meaningful on a sort of shorter term, up to kind of half hourly settlement, the challenge is immense, and the only way that can be done is with aggregation across lots of sites, lots of assets, to make the whole thing balanced. But of course, the prices that are going to be generated in those peak periods are going to be very, very spiky, and that, if it can feature as part of the sort of revenue stack for a battery, is going to be really helpful. But there's some commercial complexity around all of that works that needs to be figured out. But I can't help but see that there wouldn't be demand for that type of service.
Sure. Yeah, Scott, from your point of view, as an optimizer?
Well, I think that there will be demand from some in the market. Big blue chips who take their net zero pathway incredibly serious will be looking to power match half hour by half hour. And that to do that, you need to have a PPA from a variable output, essentially from a renewable, and you need to couple that with battery to try and smooth the shape and to try and move it to match your load. I think it's inevitable. I think it might not filter down massively through the market. I think it'll be for the big blue chips who can afford it. I think it will be expensive to basically have to toll a battery and a PPA at the same time to try and match your shape. But yeah, I think that there will be those who put a premium on that type of time match rego, as Henry kind of put it, and it will be a possibility for some assets.
I'm really excited about the idea of these time match regos. I think they're a great opportunity for battery assets. And I think it'll be interesting to see how the structuring of these hybrid projects shake out in terms of like the PPA structuring. So I'm not an expert on it, but I think at the moment you can either have, let's say, a standalone solar asset with a PPA with a battery that sits there, or like a combined PPA solar. And I think that will be really interesting to see which way the market sort of chooses to go down and where the value is. And I think that will link into whether or not these batteries are going to be primarily trying to load shift for the renewable assets, or whether and bundling up for these blue chips, as you were saying, Andy or Scott, or whether or not they're going to trying to be running effectively a battery on a current sort of standalone battery strategy at the same time, or switching between the two depending on like opportunity value, perhaps.
Excellent. Okay, folks, it's been really enjoyable, and I think with every answer and every point that you guys make, I kind of feel like both I and the audience think, oh, hang on, there's something else we can really get our teeth into discussing. But I guess in the interest of time, we are going to have to call a stop to it for today. So I just want to say on behalf of myself and everyone at Solar Media and Energy Storage News, thank you so much to the audience for joining us. Thank you so much to our speakers as well. Thank you very much, Charlie.
Pleasure.
Thank you, Henry.
Thank you.
And of course, thanks so much, Scott, not only for participating, but also leading discussion in such an expert fashion. Thank you very much for your time.
Thanks, Andy. Thanks, everyone, for joining.
Brilliant. All the best. Bye for now, everyone.
Yes.